That looks good. I've just started the recording for the presentation, and I think without further ado, I'm going to hand the floor to you, and then towards the tail end of the call, we're going to have a period of time for questions that you can ask of Tom, and then we can cover each one of those if we have enough time. So Tom, take it away, and then whenever you're done, just hand the floor back to me.
All right, as Brett said, my name is Tom McAlone, and we're here to give you a preview, a little bit of bio information on me. I'm an active member of the TSAA, and my focus is on developing and implementing technical trading systems from an algorithmic and statistical approach. I've got a master's and a bachelor's from Berkeley in math. This course really came about after a series of guest lectures I gave in Roman's FI 358 class. And lastly, previous to this, I worked in purchasing and did a lot of statistically based forecasting of food and industrial commodities. So let me go ahead and start by reviewing the webinar objectives. First is to review several key themes that we're going to be talking about during the class. Second of all, I want to leave you with some understanding of some technical methods. So we're actually going to work through some things with financial data and trading systems. Also some examples of TradeStation and AmiBroker. Those are the two softwares that I'll be using in the class, and students will have access via TradeStation to a student account for the time that they're in the class, which is a good value. And finally, I want to answer any questions regarding the class. Since we are going to be talking about specific assets and trading systems, a second here, I got to get my slideshow going. So there we go, and there's the disclaimer slide. All this information is educational. None of them is intended to be a recommendation on a trading system, and it should not be considered personal investment advice. All right, well, let's get in. The first key theme that we're going to talk about today is luck versus skill. I think intuitively we understand that there's a large amount of noise in financial data. Michael Mauboussin really has looked at this in more depth in his book, The Success Equation, and what he uses is a key equation from true score theory that looks at outcomes, and when we talk about outcomes, we're talking about financial results, and divides that into luck and skill. And let me flip to the next slide. And this is a skill luck continuum that he put together in his book. And as you can see, a lot of his book has to do with sports. And right here is his ranking of kind of where sports lie on this continuum. Chess over here is on pure skill. Basketball, because there's a lot of touches with skilled players. And oops, here we are, nudged right up close to luck. So definitions for our talk and class, the skill that we're going to talk about are going to be patterns generated by underlying technical analysis processes. So that's the base. This is definitely kind of a supervised learning process. We're going to come in with some preconceived notions, but luck is going to be the outcomes of a random trading process, and we're going to apply those to technical trading systems. Backtesting. Backtesting is really where we begin, and Howard Bandy's books are going to be the core of the course in terms of a theoretical standpoint. And a key quote from him is, backtesting is necessary but not sufficient. Unfortunately, a lot of trading system developers consider this the last step instead of just the jumping off point. But think about it, since we're looking for financial outcomes, what's going to happen is we're going to see both technical patterns and noise included. And depending on how you develop the trading system, you've got to have you're going to have multiple biases. You're going to overstate the returns and underestimate the risks. A good place to start in trying to untangle the biases and the skill and the luck is to start to look at distributions. So rather than looking at a simple equity curve of a backtest, we're going to look deeper and broader in terms of distributions. So let's start with an example, and we're going to use, for the discussions today, we're going to use the SPY, the ETF, and also we're not going to go into a lot of math today. So for our definition, a distribution is simply going to be a histogram of a set of trades or return outcomes. Visuals are going to be a key part of how I like to look at data, and we're going to let Excel do the hard work generating the calculations. And looking at, because there's a lot of different trading systems that have different kind of trade sequences. I like to look at the monthly distribution, the monthly return distribution. That gives us kind of a common denominator, and you'll see that as we go through the examples. Time frame is from 1999 to 2013, and total return data is my preferred method, because I think it allows patterns to be more easily identified, because you've got that predictable dividend stream. If you pull that out, you're essentially pulling out some, quote, skill that is somewhat predictable. Here's a plot, a visual of the data we're going to be discussing. As you can see, a lot of consolidation, and then still some up here at the end, as I think we're all well aware of. Okay, this is what that distribution looks like. Histogram, percentage monthly returns. As you can see, it's pretty ugly for those of you who are used to a normal curve. You got some fat tails out here. We'll describe those in a little more detail. We just want to set the stage visually. Properties. Mean, that's the arithmetic average. Standard deviation really talks about that dispersion. Financial data has a lot of dispersion. Percentiles often work well with this sort of data because of the awkwardness of the distribution. 50th percentile basically is the sample midpoint. Skew and kurtosis are things that we want to pay some attention to. And kurtosis has to do with the fat tails, and skew manages the asymmetry. Again, as part of the class, we'll be a lot more formal with this, but you use the definitions in Howard's work. We're going to use Excel, so here's a quick snapshot of a list of returns. That's change P, as well as the monthly dates, and some statistics on the side. As you can see, there's a large difference between the average and the spread, the standard deviation. Some negative skewness, no surprise there, as well as fat tails. And the Sharpe Ratio, which is something we'll get into from a definitional standpoint a little bit later, is pretty low for the asset as a whole. Just a visual to help you place these things. Two standard deviations. You see there's quite a bit of action outside, and the median is here in this bucket, and the mean is over here. Normal distributions have many good properties, and people refer to those as bell curves. They're completely characterized by their mean invariances. Repeating financial data is not normal. Stock returns often have a negative skew, as we happen to see here. And one of the interesting things from my standpoint is that professional portfolio managers who focus mostly on technical analysis drive their performance by managing those higher level moments, standard deviation, skew, and kurtosis. And one of the things I'm going to do is, as part of the follow-up on this talk, is send out a bibliography, and I'll give you a link to that paper. I think you'll all find it very interesting, and it's pretty recent. Now let's compare the return distribution to the normal. So we kept the monthly returns in blue, and then I put in here the normal distribution, assuming that it's completely defined by the mean and the variance. As you can see, the fat tails are much more prominent here. They stand out also, as well as these spikes. And you'll see that some more as we go through and start to analyze some simple strategies. So the first example that we're going to do is a simple mean reversion detrended oscillator system that actually Dr. Bandy used in his, he gave a presentation for the same group, TSAASF, July of last year, and that's actually on YouTube. And I would encourage you, if you're interested in these processes we're discussing, to take a good look at that. That goes into some more details than I will today. We're going to use AmiBroker over the data period, which is 2 years longer than his presentation, as well as the data I'm going to be processing today has dividends in it, total return data. Here's a key code fragment. A detrended oscillator is simply taking the 10-day moving average, subtracting it from the close, dividing it by the mean to standardize it to get an oscillator. Preset are the thresholds, -1 to buy. This is a mean reversion system, so you're going to buy when you're going down, and when you get some momentum going up, you're going to sell. You're going to sell when you cross 0. Initial equity is 10,000. We're also going to allow reinvestments. The recommended way is to use fixed position sizing when you build a model. That helps you understand clearly the patterns you're picking up. In this case, I'm going to use a lot of references to buy and hold, and so you can't really compare anything to buy and hold when you're using fixed position sizing. I'll show you a little bit of the details, but the model does fairly well. 7.8% annual return over the period 1999 to 2013. Certainly does have some drawdown. It's got a pretty significant drawdown at 24%, but certainly a lot better than a drawdown that we would see with buy and hold. So here are the signals that you're getting from the system. Reinforces the definition. You can see buy here, sell here. This is a key characteristic of mean reversion systems. You're buying, whoops, you go down, you've got to be able to hang in, it goes up here. Here are the financials. And this is a snapshot to give you a feel for what comes out of AmiBroker. A lot of good data. You've got your net profit. You've got your annual return percentage, trade drawdown, and winning percentage. And I think that's a key factor. One of the things that we will continue to look for is those things that have some statistical significance to them from that standpoint. And winning percentage actually is one that's surprisingly good that way. Okay. Here's the equity curve. Again, snapshot directly out of AmiBroker. You can see both good performance on an annual return basis as well as some of the choppiness. Monthly returns. Another viewpoint, and this is essentially taking all the returns and just graphing them across and this is 5%, 10%, 15%, and then the negative values. Here are the, now let's look at a distribution. This is comparing it to itself. So in red, so this is the distribution. You can see we've pulled in some of these negative, but also positive. So again, you have to take the good with the bad. And in the red is the normal distribution based on the mean and variance of the blue distribution. Another thing I think it's helpful to see kind of what the progress we've been making with this technical analysis process is comparing it to the original distribution. And you can see that we've certainly got rid, we've still got a few fat tails here, but we've reduced those, and we're also pushing the trades into the middle of the distribution, and since we are positive in terms of return, we're over on this side, which is a good thing, and we're underperforming in some sense, which is also a good thing in terms of the what you would expect on the negative side versus a normal distribution. So certainly, and that shows you in the financial results. Here's some of the key statistics. This is detrended oscillator. Here's the mean. So outperforming. We're also, not only are we outperforming on the mean, but we're also reducing the standard deviation. So we're getting more control, having more return. Whoops. Well, we get a little bit more negative skew. That we'll work on that a little bit here coming up. And the fat tails, we're pushing that out. I think one of the problems is that that is reading some of the peakedness. It reads the deviations kind of in a vertical method, and so you're getting some of that on the top side. Sharpe ratio's improved, double the Sharpe ratio, which is a good result. We're still not where I'd like to be, which is definitely over 1. Monte Carlo simulations. Now we're going to talk a little bit more about the spread. And basically, a Monte Carlo simulation is a method for generating a distribution from a single equity curve, or modeling luck in our terms. We're simply pulling trades out of a set of trades with replacement for a specific number to get alternate sequences. I'll show you a graph of the results, and this is pretty interesting. We call this the Broomstick Chart. This is 26 trades pulled at random using random function, and these are the equity curves. So this is, kind of some validation, if you will, of why you need to look at more than just the equity curve. You really need to understand, what the variance is, and because you could have been on any one of these paths and still be within kind of a statistical, it came out of the same trade pot. We use the random between function and the offset function, pretty easy to generate these graphs. We may use an Excel add-on if we need to during the class. Well, the variance that we saw is directly related to the magnitude of the standard deviation. A key financial and statistical metric is the Sharpe ratio. It has in its numerator excess annual returns, and in its denominator the standard deviation times the square root of 12 to annualize it. So what I'm going to be using throughout this presentation, throughout the class, is the annualized Sharpe ratio. Both computer programs that we will be using generate the Sharpe ratio based on trades, so it's hard to relate those two. I think technical trading systems ought to have a goal of having a Sharpe ratio on this definition between 1 and 0. To make things easy, I use a zero rate assumption, so it's not a historical Sharpe ratio, but given how quantitative easing has adjusted the Treasury bill rate, I think it's pretty relevant today and makes things a lot easier in terms of calculation. Second example we're going to do is to try and work on how to filter the bad trades out that generate that 24% drawdown. So the goal would be to use some sort of filter. I'm going to pick the most basic one that I think we all know, which is a 200-day moving average. And I'm going to add that to the buy rule. So we'll use the same oscillator, but what we're going to do is we're just going to make sure that the close is greater than the threshold. Same assumptions in terms of equity. Our rate of return is reduced from 7.8 to 6.3, not a surprise, but we also have a much more significant reduction in the drawdown as well as an increase in the winning percentage. So basically what we're doing is we're taking this system and again and trying to move it into an area that will start to show some better skill in terms of drawdown and winning percentage, etc. Here's the equity curve. As you can see, it doesn't trade as frequently, so there's some big gaps in the trading. No surprise where those gaps lie. Those are where it filters the trades out. Obviously, if you were going to develop this in a serious trading approach, you probably want to investigate a lot of filters. Filters are something that seem to work very well. As a matter of fact, it's interesting side bit. The gentleman, David Arnson, who wrote evidence-based technical analysis, where he did a bunch of math and determined some simple formulas, didn't give you much, is now out with software that uses filters and helps people with trading systems by filtering the signals. So I just thought that was kind of an interesting aside. Here are the monthly returns. I kept these on the same scale, so again, the 15 to minus 15 scale, so you definitely can see the improvement, and you also see the gaps. Here are the monthly returns. More scrunching. It still is technically against itself, has some fat tails, and we'll see that as we look at the statistics. But the good news here is versus where we started, which was with the asset returns, we've in a sense completely eliminated the fat tail process that goes along with the financial return. So certainly much better performance than a simple buy and hold strategy. Here are the statistics. We're still above buy and hold, which is pretty interesting. We've dramatically improved the standard deviation. We fixed the skew. And also the Sharpe ratio is just touched over that 1 to 2 Sharpe ratio range that I talked about earlier. So the next question that we want to address, and another key concept, is whenever you do this, you got to say, hey, can these results be replicated by luck? And our definition of luck is that we look at a random set of trades. The way I generated these random set of trades with some TradeStation software that actually gives us the same number and length of trades. So basically, it's a trading system, if you will, that operates on the SPY and randomly picks a trade, and then through the limits on the random, you get pretty close to, on average, the trade profile that you're trying to match. The other thing that I think is key is I like to use the 95% percentile values as the critical benchmarks as opposed to any sort of standard deviation calculations. That's obviously the Sharpe ratio has those in them and is a good benchmark. but whether or not you're statistically significant is probably more relevant on a percentile basis.
Hey, Tom.
Here are the results from the random trades.
Tom, can I interrupt you for a second? It's Brad.
Sure.
We have a couple of questions, and I think that this is a good time to actually ask them. One gentleman asked if you would elaborate on how the buy and sell signals are generated, and then also if there are some costs incorporated in the system for the trades.
Yep. Okay, so number one, there are no costs associated. My goal here was to demonstrate, not that I've got something that can make money, but something that shows statistical significance. The trading rules, let me go back to the slide here. Nope, wrong way. So the trading rules are here. So so we calculate an oscillator, and we calculate that by essentially taking two things. One is the close, taking a moving average of that, we call that the mean, and then we simply subtract that from the close, and we normalize that. And so basically you've got a price-only oscillator that is generating the signals, and when that goes below -1, you buy. This is mean reversion, not momentum. And then when you sell when it gets some momentum and crosses back over 0. So that's the and here's the signals. So to understand that, you can see the it buys here, it's going to sell here, buys here, sells here. So these are the signals. And one of the things I should have done is probably put a graph of the oscillator in there. Sorry about that.
Okay, and then just a follow-up question is curve fitting a concern?
Oh, absolutely. Yeah, absolutely. What I wanted to do here, so curve fitting has to do with data mining. So the more choices you make, the more important curve fitting is. And at this point, I wanted to illustrate how the quantitative methods interact with the backtest. We definitely will be doing a lot of tests in terms of curve fitting. Basically, what you have to do is I did 500. So on this chart here, I did 500 replications to get my 95% percentile levels. If you're starting to make choices, you have to then amp up the number of replications to take into account the number of choices you're making. And certainly, curve fitting is a key thing. The other thing that I'm not going to talk about today, but something that pervades the right process, is looking at walk-forward optimization. And walk-forward optimization really tells you what the real world is, because basically you adjust your parameters as you go, and you only look at out-of-sample data. So one of the keys is looking at in-sample and out-of-sample, and we'll do a little bit of that on the last example. Okay, good. So keep the questions coming. I think that makes the presentation more interactive. So back on the random trade results, the system has 102 trades, and the system that I used to generate this random table, I show you here the different trades, and the minimum trade that's in this the minimum system that's in this trade 87 times, and the maximum 107, and on average it traded 100. So pretty close from that standpoint. What were the results of all these trades? And again, this is pure luck. Well, one of the things that's very interesting is that on the mean, while statistically it's over the 95% threshold, there's actually one system that does slightly better. And I think what this shows you is the power of luck. And So to make something come out of that luck, and it goes all the way back, if you think about that first chart we led off with, how close that nice little graph of the technical system is to luck. And the key is you've got to have the right measures to untangle that. And frankly, net profit is not a good optimization measure because you just end up chasing luck. And you're kind of chasing your tail. Standard deviation, well, kind of a similar thing there. It's interesting, but the problem is this is just looking at individual systems. This doesn't take the mean and the standard deviation together. So yes, in terms of luck, you can get something that's better than the mean and has a lower standard deviation. But the real question is, can you get them in the same system? And that's what the Sharpe ratio does. So if you look at the Sharpe ratio of all the systems, the maximum is 0.8, and it may very well be this system because it obviously has in its numerator, it has the return, annualized return, and in its denominator, it has the standard deviation. So none of these systems even come close to matching the Sharpe ratio. So for me, that's the type of statistic that we want to use to avoid the curve fitting problem and to let the luck, push the luck down and let the skill come out as we try and find those patterns based on technical analysis. Next system I want to go over is a trend following system. I'm not going to go the standard moving average crossover. I'm sure you're tired of seeing that. But I wanted to bring this, some literature to your attention. It's very interesting. It seems like in the last 10 years, there's been a lot more activity in terms of academics, coming to the fore and supporting, technical analysis, pattern matching, algorithmic trading. This is a gentleman, and I'm certainly not going to try and pronounce his name. I butcher it. But he's a business school professor from Australia, and he demonstrated in what I would consider a laboratory setting, which is the decile profiles from Ken French data set. Ken French is half of the famous Feynman French group, authored a number of papers that can outperform on the mean, standard deviation, and skew metrics in a statistically significant manner. So that's pretty interesting. He also noted in the paper that when he applied the same methodology used, and he's much more sophisticated statistically than anything that we're going to cover in the class, only a quarter of the individual stocks showed statistically significant performance. So I think that shows you that you've got to be a little bit smarter if you want to trade momentum, and because you have to somehow replace the noise reduction features when you that you get from a portfolio or an ensemble or a committee. And what we're going to do is try and anticipate some of the crosses, because I think underlying it's still a good strategy, but it's been overutilized and there's definitely too much noise. So here's the technical model we're going to use. We're going to try and keep it simple. That's certainly a watchword that you'll hear from me, and I think it has a lot of validity to it. It also gets back into the skill versus luck or signal versus noise. The more complex you make your algorithms, the more likely you are to pick up noise, and it's hard to squeeze it out. Here, the entries are going to be triggered by a smooth 200 look-back period RSI, and we're going to optimize the threshold level. So now we're getting into some optimization. The two examples before were just take a system and analyze it. You don't necessarily have to worry as much about data mining in that setting. Definitely you do here. But I'm going to keep the optimizations to a minimum. So we've got an optimized threshold level. I'm going to pick 5 different points. The exits are going to be using an ATR trailing stop. and that's going to be augmented by a simple percentage stop for the first X days, 20, 30, 40. We're going to optimize that variable. That gives the ATR function some room to settle out. One of the things you find when you try and slap it right into a momentum system is the fact that you've got to let the system kind of start to go up before the ATR makes any sense, but you need to control risk as well. So that's part of a way to handle that. If we have a false signal, meaning, hey, we trigger a stop and it still hangs around, there's a rebuy process in there based on a threshold that will get us back into the market. And as I already stated, we're going to keep the optimizations low. So the testing approach. So talking about curve fitting, we're going to use a very simple method: train, test, and validate. So you take a set of data for training. We call that the in-sample period. That's from 1998 to 2007. We're going to train on that. That data is really no good for any sort of financial metrics. I'll show you some of it because obviously it just essentially it only works to throw systems out. It doesn't work to keep systems in. The testing data, and this is where we will look at how does the selected model work, and then finally a validation. We've got to make a decision. We take a data sample, and we see if we've got a valid model. The walk-forward process is a superior process to this one. The problem is it requires an absolute commitment to the fitness function. You think about the fitness function, basically what we're trying to do is trying to come up with a mathematical method for communicating to the computers what we would like to see. And one of my favorite ones, which we'll talk about a little later, is the K ratio. That's a mathematical way of saying you've got a straight equity curve. So that's the fitness function. Howard Bandy recommends essentially that you try a bunch of them out. You go and you look at your equity curves and decide what fitness function or what communication method with the computer you like. The other thing you want to do is you do want to look at periods in time, if you can, and it's not always available, that have both ups and downs included. So here's the output, and this model is one that I use TradeStation on, and this is a report on TradeStation. I've cut it down, but you can see here that the in-sample data is strongly selecting 7 as the ATR multiple, and there we went from 3 to 7, so it picked the highest one. It's also got a fairly strong recommendation that 50 days or 50% is a good threshold for the buy-sell threshold, or the buy threshold. The sell is the ATR. It's pretty agnostic, if you will, about how many days look back on this, what I call the flip variable, or where it switches. Doesn't really care. And the early loss, doesn't really care very much. I think the in-sample data suggests, again, it's only a suggestion, that a model of 57, 2, and then I picked 30 just because it's right in the middle of those two values, basically. And generally, you want to look for a plateau, if you can find one in terms of your parameters, and try and hit in the center of that. That obviously gives your system stability. You also want to look at the signals. You put a system together, and once again, you're communicating with the computer against some data. I can't tell you the number of times where I program something in and I get a flurry of buy and sell signals, and I go, boy, what happened? Then I look at the data or I look at the signal, and obviously I had something that was silly in the signal, and the computer just took me literally. This is at the end of the period in 2007, and you can see that it operates pretty well. It gets out early. That's what you'd expect in this sort of a system. That, I guess it's not going to happen now. A lot of jittery. If you remember back, there was a lot of activity in early in 2007. It gets back again. It gets out again. Pretty lucky here in the sense that you had up and down. It's never going to be smart enough because, you know, what the optimization is telling us is you got to give this asset some room to work. So this is the impact of the 7 ATR. It definitely lags. And here, hey, it's going to get in again, but this time it gets out. So from my standpoint, you know, what we're looking for is we're trying to communicate with a computer, you know, how to get the right signals. And I think in this, my takeaway here is, hey, I'm getting the right signals. This is a sample of some financial data. For my money, these computer systems spit out way too much information, and you kind of get information overload. And remember, financial statistics are outcome-based. What we're looking at is for something that gives us a hint that there's some skill there. But just to reference the, here's the annualized 6.5, so reasonably okay result there. Equity curve, it delivers a pretty good equity curve. It obviously got out here, it learned. So as it's going through its processing and optimizing, it learns based on bad performance results that you didn't want to be in the market here. Okay, we talked about these thresholds. We talked again about the K ratio. Now this is a key one for me. So one of the things is I'm looking for skill. One of the skills that you're going to have is a flat equity curve. Hard to get that with luck. And so TradeStation has a benchmark of 2.5 as a good system. This is over that. And so, you know, that starts to tell us that there's some skill there. One of the features of TradeStation is you can actually run it a second time and designate a period where it doesn't optimize. Now, anytime that you're testing your system, you've got to consider that in sample data. So basically, that's the test part. You run that through the system, and there's a number out on the side for the robustness index, and that kind of gives you a feel for how it did in the tests. All the leading candidates here would perform well, so the model appears stable. So here is the out-of-sample signals. No surprise that in 2013 it did very well because it's smart enough to stay away from this volatility here. And this is the signal that's actually generating the trades. So this is the lower threshold, and this is the upper threshold. The upper threshold is for an early buy. This is for a rebuy, and you can see that the signal is generated when it crosses here. It also has to have a positive rate of change. Here are the statistics. So we want to start to look at how does this work in 3 different places: in sample, test, out of sample. The good news is there's much more stability on our model results, and again, this is monthly return percentages. 51, 62, 69 versus the asset, 36 minus 3, 1.31. So it outperforms. So buy and hold worked better than this system because the system's going to get out, but it's much more consistent. Same thing on standard deviations. As you would expect, the Sharpe ratio is better and consistent. not quite at 1. So that gives some flavor. So in terms of curve fitting, did we curve fit? Probably not, because it has some good statistical properties in the out-of-sample data. So that's the key, because while it understood what was going on here and it grabbed luck, here I would have changed the model, but it didn't change the model. And you can see that there's definitely some consistency in the key measures, which says that I have some stability. There's the final profit curve, no surprise. Let's talk about model and data synchronization. By design, our models are static or at best adaptive. If you've developed a model through walk forward, you've got some adaptation, or maybe you have some indicators that have some adaptive values, but the data is always much more dynamic. Outcomes are based, dependent on the synchronization between the two parts as developed during the training, testing, and as evidenced in the validation. The key point, this relationship can and will break down. If you look at the literature in terms, the literature that's coming to the fore now more than ever before, you know, there's people like Chris Neely, who's a Fed economist, but the bottom line is you can see relationships, but those relationships will change. So you've got to be prepared to constantly monitor the system health, and if you see a relationship changing, you've got to reduce your position size or take the system offline. And again, you want to look at things that aren't always or have performance relationships, but they're more tangential. Winning percentage, performance versus buy and hold, trade patterns are key items. So maybe Brett, if we could, are there any more questions before I get into the kind of the class as a whole?
Yes, yep, we got about 10 minutes left, and there is one question from Mark. He wanted to know how the returns generated by your system compared to the market. In other words, the 6.5% CAGR versus what?
Oh, okay. So it's versus, so the market is versus S&P. So whenever, so for example, on this one, in the in-sample period, the buy and hold returns for S&P were on average, monthly average 0.36. The system return was 0.51. During here, and this is 2008 to 2010, so I have periods of down and up. And so the S&P recovered, but this system was much more steady. Here, when it's going like crazy, a system like the system that we demonstrated here, there's no way it's going to keep up with buy and hold. So that'll give you a picture of what's happened. So in those statistics, I like to look at how it performs versus the market, because I think that's pretty relevant. Some of the graphs I haven't done that. So for example, on this one, I didn't bother to put the buy and hold graph in there. Okay, any other questions?
That's it.
All right, so what I've done is pretty much, I've gone over, bits and pieces through the first 4. We're going to get in depth on objective functions. That's a key for you personally. You've got to have confidence in your objective functions. We'll do a lot more on system validation. Haven't talked at all about risk management. That's absolutely a key. And Howard Bandy has some really excellent ways. I personally like to do trailing stops, but that's a personal preference. Mean reversion systems and trailing stops don't work well. He's got some very innovative methods for position sizing in an aggregate. Monitoring system health, developing things that work for your style of trading. Filtering, rotational systems. We will cover a system that is a rotational system. That one is probably not going to be able to get a Sharpe ratio over 1, but definitely we'll get it, try and get it, it will be much better than the buy and hold metric. We're going to also do an intraday system. So one of the things that I like, is going to be part of this class is to try and look at these specific techniques across as many different trading styles as we can. I'm certainly open to different trading styles and trying to utilize the statistical techniques. Portfolios, we will include a multiple asset system. One of the other things that is pretty interesting that people haven't done a lot of research on is using technical indicators as portfolio metrics. Bringing a system on and off based on technical indicators as opposed to, oh shit, the correlation is blown up, what do I do now? So trying to look ahead a little bit. Trading plan presentations, each of you will be asked to do a presentation. Since this is an online course, I'm going to meet with you one-on-one through a webinar and then meet again to film it. So I'm trying to make this look and feel as much like a face-to-face class as I can, and certainly the technology should allow us to do that. These are some advanced topics. Visual backtesting. There are some algorithmic methods, particularly one by Andrew Lowe called kernel regression, but that's pretty sophisticated method, but that's something I'm going to cover and would be glad to help somebody along to learn that if they've got a certain level of skill. The learning objectives. So, what are the deliverables for the class? You're going to learn how to build, optimize, and validate a trading system or an active investing system. I consider momentum, longer-term trading to be active investing, and we'll use monthly returns to make it statistically viable. Alternate systems, talked about that. You will learn how to do, using Excel, part of your homework, part of your trading plan presentation, and hopefully part of your ongoing life is to apply these techniques. And I want to make sure you leave the class with the skills to do it. Separate luck from skill. You need to work this through and keep practicing, and then I think you'll start to see it. And finally, the highest level skill will hopefully be able to evaluate confidently. You've got to develop a trading system. How good is it? And when can you move into real-time trading? And almost as importantly, if you're in a trading system, when you can move it offline if the system health measures start to deteriorate or reduce position size. The details, it's going to be taught online through Golden Gate. I'm going to include 1 to 3 webinars. It is a 3-unit graduate course. It runs from April 30th to August 12th. The costs are just like any other GGU course, $2,600 for credit, and then there is an option as an auditor, $1,750. From my standpoint, the only difference is you're not going to get a grade. So there's going to be no difference in terms of the content and deliverables from my standpoint as an instructor. Obviously, you're not, if the grade's important, full credit's the way to go. How to register? Here's the website. There will be a syllabus posted. I have a syllabus. If anybody's really interested in getting their hands on one right now, I can email you one. I've got it, going through the process. So, any more questions from the audience?
If you would like to ask a question of Tom, you can either, there's a little round circle with a hand. You can raise your hand, in which case I'll unmute you, and you can use your microphone to communicate with us. Or you can type a question into the chat room or just into the question box. Are there any questions? We'll take a moment to collect some questions. As you're deciding to do that, let me just cover a couple of important points I don't want you to go without. One is that a common question is how long do I have before the class starts to register? You can actually wait until the day that the class starts. You don't have to register. There's no deadline prior to the beginning of the class, although it is advisable that if you want to register, you should probably start the initial registration process now, especially if you want to take it for credit. And then the other question we had was whether or not the slides are going to be available. Yes, we can email you a copy of the slides. And also this recording is going to be posted to YouTube, so you can always access that and watch it as well. Okay, it doesn't look like we have any further questions, Tom, so if you want to have a parting comment, feel free.
Oh, yeah, well, okay, thank you very much for listening. I look forward to working with some of you in the class, and certainly if you've got any questions to think about after the session, you've got my email is tom.macalone@gmail.com. So feel free to do that, and I look forward to seeing some of you. Thank you very much.
Thank you, Tom, and thank you, everyone, for attending. Have a good day.